Good day, and welcome to CBRE's Global Insights. I am Raymond Toro, CBRE's Global Chief Economist and host of Global Insights. My guest today is Abigail Pitzner, Global Economist for CBRE. Abby has been with us for almost 3 years, working on all things global. She has 2 degrees from the University of Wisconsin and is an avid and devoted cheesehead. Currently, Abby is working on a second master's degree at the University of Denver. Before we turn to today's discussion, I should mention that the full market view on the office indices is available online at CBRE.com. Welcome, Abby.
Well, hello, Ray. Thanks for having me.
It's a pleasure to have you here. You do great work, and I'm interested to see what you're going to say today in terms of the first quarter 2013 CBRE office and office capital value and office rent indices. What are they telling us, Abby?
Yes, indeed. So what we found this quarter, as with last quarter, actually was a continued divergence in performance between office rents and office capital values. And we had global office capital values improve again this quarter, while we had the global office rent index held stable over the quarter. Sure. Well, given that the global office capital value index has outperformed the global office rent index, I've featured that chart here first. And this chart features both the global and our regional office capital value index levels with a base period of Q1 2001. And you can see from the graphic that our global office capital value index grew by 0.9% quarter over quarter and 2.5% year over year. And there's a couple driving forces behind why we're finding that commercial real estate's capital values are seeing stronger growth relative to office rents. The first relates to the migration of capital that we're seeing from other asset classes venturing into commercial real estate for the relatively higher risk-adjusted returns that can be achieved. And then in addition to all that extra capital flowing into commercial real estate, we're also finding that investor sentiments are still quite conservative, with a focus still on capital preservation and risk aversion to an extent. So these sentiments have directed investors towards the best properties with the most stable occupiers in the best, most liquid, transparent markets. And so these types of prime assets are really still hard to come by. And this dynamic has really caused pricing for these types of assets to become very aggressive. So these two dynamics have sort of widened the yield spread between primary and secondary property, which has directly impacted the performance of what you're looking at here, which is our prime global office capital value indices.
So we have a lot of capital, Abby, and not a lot of product? Simple
exactly.
Demand, supply? Yeah.
Yes.
But,
the classic demand, supply.
You know, it is, I think, interesting looking at this graphic to note that the first derivative is slowing down, right? The rate of change of the index is certainly slowing, although I guess as I look at it, that's not true for the Americas, but certainly true for the other regions in the overall index.
Yes, that is, you're right on track, actually. That's exactly my next point, which was that you can see quite dramatically.
Got to stop working together so much, Abby. So.
I know, we're always on the same wavelength.
Go ahead.
You can see that if you look really around the 2011 period up to current for nearly all of the indices, if you just look at the purple index, which is our global index, the pace of growth has really slowed down relative to the stronger recovery quarters that we saw during late 2009, early 2010. Mm-hmm. And it's definitely very, very apparent in this slide, so it's a great point to bring up. And that's actually a good transition point to talk about our Americas Capital Value Index, because as you mentioned, the Americas Index has shown clearly a stronger upward trajectory relative to the other two regions during that 2011 to current period. And the Americas Index is in the light green line there. And this quarter, it continued to post the strongest performance of all of the three regions, and it grew 1.5% quarter over quarter and 5.9% year over year.
Mm-hmm.
So an interesting point, too, actually, with the U.S. is that investor focus continues to be on those gateway markets like San Francisco and New York and D.C. and so forth. But interestingly, we saw this quarter some early signs that investors are actually beginning to carefully consider other secondary markets, and some of those include Seattle, Texas, Houston, and Dallas, and Austin, actually, and Denver, where I'm located. So this trend, the trend of investors considering these secondary markets has been small. So it's important to note that it's still small. So we haven't really seen a measurable impact on pricing or cap rate trends for these non-gateway markets just yet, but it's still worth keeping in mind this quarter that we're seeing some early signs. So,
yeah, I've always believed that when there's a clear indication the economy is picking up, those property types will become more in favor as across not only the Americas but also the other regions of the world.
Yeah, and actually, we've seen something similar for London as well, where they're noticing not only a strong investor attraction just to the prime property, but also to secondary property now, given how aggressive things are with pricing. So the next strongest regional performer for capital values is Asia Pacific, which is the black line. And Asia Pacific grew by 0.7% this quarter and 2.3% relative to last year. And it's always good to point out for Asia Pacific that it's the only regional index to have recovered and expanded beyond its pre-crisis peak. So even though, as I mentioned a little bit earlier, that even though we've seen the rate of growth slow over the last several quarters since about 2011, given that the Asia Pacific index has expanded beyond that peak level, it's somewhat natural to expect that the rate of growth for Asia Pacific would moderate in more recent quarters. Mm-hmm. And then this quarter was actually the second consecutive quarter of positive growth for the EMEA Capital Value Index, and it grew by 0.6% quarter over quarter, so much more moderated than the other two regions. And relative to last year, its capital values are down slightly by 0.2%, and that's really due to the ongoing recession in Europe and the risk aversion that investors still have, and they remain very focused on the prime assets and the primary markets. And in this case, for EMEA, some of the most popular markets are London, Paris, and the major German markets.
But it's certainly clear as you look at both the level of the CBRE Capital Value Index and the rate of change of some of those lines, they reflect the general trends of their respective economies.
Very much so, yep. Absolutely.
Okay. So what's Rents telling us?
So, yes, we're on to the next slide here. As opposed to the Capital Value Index, where we saw a gradual uptick since the beginning of 2011, the Global Office Rent Index has seen much flatter growth over that same period. And this quarter it held steady, actually due to a temperance in growth in the Americas and stability in Asia Pacific and EMEA. So similar to the first chart, this chart shows our Global Office Rent Index levels to a base period of Q1 2001. And so our global series here has increased by 0.8% relative to last year. So again, when you're comparing capital values, the global series to the office series, 2.5% versus 0.8% is quite different and divergent. And so when we say the global office rent markets are recovering gradually, we definitely mean it. And then, another point, too, that we like to bring up is that the stability of the office rent index isn't necessarily a bad thing. Global occupier demand is still pretty weak, and many occupiers are still focused on cost containment. So the availabilities and preference for prime space in the best office locations has really serve to maintain the rent levels that we have until occupier demand strengthens. And on a regional basis, again, we have the strongest growth in the Americas, but this quarter, actually, the Americas has tapered off slightly. And over the last 6 quarters, the Americas really served to uplift the global index. But the tapering this quarter can really just be attributed to the fact that markets within the U.S. in particular, which had led the region in recovery performance in previous quarters, and those kind of markets were linked to technology and energy sectors, they're now more naturally witnessing that pace of rental growth slow. So we're seeing that reflected in the index as well. And then both our Asia Pacific and EMEA rent indices were flat this quarter, which is very, very apparent in the chart. And Asia Pacific's office rent index has seen little variation, over the last 6 quarters. But it is worth noting that this quarter, its growth is an improvement over last quarter because last quarter was actually a slight decline. So this quarter it saw about a 0.1% increase. Okay. And then finally, our EMEA rent index, which is the dark green line, was also flat. And again, the occupiers within those markets continue to implement those cost containment strategies. So it's also worth noting, too, that there were some rental declines actually present for parts of Southern Europe. And then those declines were offset by increases in some of the Northern European markets like Norway and Germany and London West End in the UK.
Okay.
So to sum it all up, again, we have some key takeaway points, which are that we found continued divergence in our global office performance, and we saw further slight appreciation in the capital value index and a pause in global office rents. And we like to point out, too, that our expectation is for continued strengthening in both rent and capital value indices as economic headwinds become more ingrained in business sentiment and certainly as occupiers regain confidence in their expansion strategies and so forth. And another point, too, that we mentioned earlier within the capital indices is that as economic growth gradually gains traction, we also expect to see a further migration in capital, and we've actually seen this in the U.S. and London, as investors shift their focus off strictly the very expensive gateway markets and prime assets towards considering their other secondary markets and non-core properties with less aggressive pricing.
Your what I would call a slightly optimistic but outlook is predicated on an improving economy.
It is definitely predicated on that, and it's predicated on a very gradual improvement in line with what the expectations for economic fundamentals are, which is also very gradual growth.
Well, I know you do this every quarter, Abby. So
yes, we do.
We'll pick up on that very point on the next quarter and see what the second quarter tells us, whether it's more of the same or whether we start to see some acceleration. Thank you very much, Abby, for spending some time with me and talking a little bit about the CBRE Global Office Capital Value and Rent Indices. You be well.
Yes, thanks, Ray. You too. Bye-bye.
Bye-bye.